Good morning. Welcome to another Maine SBDC webinar. Today's session is about understanding the chart of accounts and financial reports in QuickBooks. And we have business advisor Christina Oddleifson from the state office at USM, who will be providing a basic overview of the major financial reports within QuickBooks and why you as the business owner need to understand them and what to pay attention to when using them. We've got a couple people who are utilizing the chat feature already to introduce themselves. Please continue to do so. Let us know maybe where you're located or what industry you're in. If you have a business link or website you'd like to share with the group, please do so. You can also submit any questions that you have right in the chat. We'll have plenty of time at the end for questions and answers. And so if your question is not answered throughout the seminar, we can have a little extra time at the end for those. You will also receive a follow-up email from me that will include the slides from today and a recording of the session. So if anything feels like it's going too fast or you just want to listen rather than take notes, all of that information will come to you this afternoon, including Tina's contact information and more information about how you can request one-on-one business advising from a certified business advisor at the Maine SBDC. Tina is a great with numbers and accounting and all this information, but you might want someone who's closer to you. So if you reach out, we can go ahead and put you in touch with the best business advisor for you. In the meantime, Tina is the best business advisor for this. So I'm going to pass the mic over to her and we'll get started.
All right, well, thank you for the introduction, Kelsey, and welcome everybody. As Kelsey said, my name is Christina Oddleifson, and I am a small business advisor at the SBDC located in Portland. But if you don't know a lot about the SBDC, we're an organization that has the mission to support small businesses throughout Maine. We are really a sub-program of the SBA. We're funded also by the state of Maine and hosted by the University of Southern Maine. So because of all that, we can provide these advising services to you at no cost. And I would, as Kelsey said, really encourage you to do it. We're here for you. No question is too small, so please reach out to us. So we're here today to talk about the chart of accounts and financial reports. And we're gonna be talking specifically about, obviously, the chart of accounts. It's the backbone of the accounting system. And we do get a lot of questions about the chart of accounts. And I think when people are asking about the chart of accounts, they're really kind of asking about accounting generally, because, as I said, it is really tied to the entire system. So we're going to talk about how the chart of accounts connects to the three major financial reports that we use to assess a business. We're going to talk about how those financial reports actually connect to each other. And then we'll talk about some best practices for managing your accounts. And I'll be going over to a dummy business account inside of QuickBooks to do that. I'm also going to be going over some basic accounting principles, some of which are double entry accounting to keep that accounting equation in balance, and accrual versus cash accounting methodology. But I'm going to try to make it easy and fun because this is not this is not a topic that a lot of small business owners love. I hear the phrase a lot that small business owners did not start their businesses because they love accounting, and that is absolutely true. You do not have to be an accountant to run a business. But you do need to understand some basic concepts so that you know that your books are accurate, because there's a phrase of garbage in, garbage out. If you don't have the right information getting organized correctly with the chart of accounts, you're not going to get the right information back. And the information you're getting back from financial reports is what you're using to manage your business. So it is important to understand a few basic things. When I think of an accounting system. I think a lot of people get a little stressed out about it because it uses language that we don't understand always as business owners. And just to give you guys a background, I was a business owner for 12 years and did my own books, and I'm now a QuickBooks Pro Advisor, but just a fancy name for doing some extra training, really. But I have been in your shoes. So an accounting system, as I said, is really just an organizational system, just like any other system. And it's a way to keep track of the financial events that impact your business every single day and give that information back to you so you can manage your business better. That's all it is, big file system. A little fun fact, a man named Luca Pacioli developed what is known as the double entry accounting system. And that is the system that we use today. And we're going to be seeing Luca in a few more slides. So let's just get right into it. What is the chart of accounts? The chart of accounts is really just a title given to the master list of accounts that you can also think of as categories that you use to organize your daily financial transactions. There are 6 major sections of that list, and if there's any takeaway from this presentation, it's hopefully having a solid understanding of what these 6 major types of accounts do and how to use them. So starting with assets, assets are things that you own. There are things that usually have value beyond a year. They it's things of value that your business has. Liabilities, on the other hand, are things that you owe to other people. Things obviously like loans, but it's also sales tax you collect but haven't paid to the state yet. It's even tips that you collect that you haven't paid to your employees. It's your credit card balances. Those are all liabilities. And then equity is probably the one concept that people struggle with the most. And one really simple way to think about equity is the same idea as net worth with individuals. It's basically if you sold off all of your assets and used the money to pay off all of your liabilities, whatever you're left with is equity. It's what you own of the company. After that, there's income accounts, which most small business owners know. That's how you track the sales of your product or service. The next category is costs of goods sold, and that is just a fancy name for direct expenses. It's expenses directly tied to the creation of your product. If you sell services, typically we don't use cost of goods sold very often in service companies. You don't have to use this category at all. It's just a way to separate out certain kinds of expenses so that we can do an analysis right at the beginning to see how well your business is doing, if you're creating enough gross profit to cover the rest of your expenses. And that's all it is. It's just a way of separating it out. And then there's just regular expenses, and these are indirect expenses, and they are tied to things that it doesn't matter how much you sell of your product, you still have to pay for these things. And this is things like your rent and insurance, utilities, things like that. So I want to talk about the accounting flow. This is something that we all deal with every day. Things happen in your business that you have to record. Those are called financial transactions. So for example, if you go out and purchase some equipment for your business, you would categorize that using an asset type account from the chart of accounts. If you take out a loan, that would be a liability. And if you as an owner give money to the business from your personal bank account and put it into your business bank account, you've just increased the equity that you have in the business. So that gets categorized as equity. All 3 of those accounts end up on the balance sheet, which is the first major financial statement. The second major financial statement is the income statement. And again, most small business owners use this statement almost exclusively. Some use the balance sheet, and we're going to talk about why you should use the balance sheet. But this captures your sales, so that's your income. It captures your cost of goods sold. If you had a bakery, it would be ingredients. It would be the labor to create the baked goods, that's your cost of goods sold. And then your regular expenses like utilities, insurance, rent, those all end up on the income statement. So there's balance sheet accounts and income statement accounts. And also, just so you know, the income statement is also referred to as the profit and loss, or the P&L. There's a third financial statement that we use. There's three major financial statements in the financial world. And the third one is called the statement of cash flows. That statement does not have its own set of accounts on the chart of accounts, but borrows accounts from the balance sheet in the income statement to create that report. And we're going to get into that, but it's also a really important tool to manage your business. So Kelsey and I have talked about this and have joked that I tend to be more of a visual learner. So I wanted to create a graphic to maybe help you understand what the three financial statements do and what they're telling you about your business. So if your business was a fruit tree, say an apple tree, and you are in the business of growing and harvesting apples, there's lots of information you need to know about your tree to know if it's healthy. So the first thing we look at is what's happening with the fruit. You know, we put in expenses like pruning the branches and fertilizer, and then we have the harvesting and the selling of apples. All of that is captured on the income statement. That's the one that we know the most. We use it to track our activity, and then at the end of the year, we stop and we start again the next year, just like a crop on a tree. So that's the income statement. But to really understand the health of your business, you need to understand what's happening to the trunk of the tree and the branches in the tree. Because if that tree needs to grow itself in order to support the activity of growing your fruit. And one way to think about that is like growth rings on a tree. Each year, the growth rings are telling you what happened to the tree. It either grew, or maybe even contracted a little bit, or it grew just a little bit. That information is captured on your balance sheet, because to have what's called a healthy balance sheet, it needs to support the activity of the fruit growing. You need to reinvest in things like new equipment and better ways of doing things. You don't want to take your profit home all the time without reinvesting into the health of that tree trunk. Because if you don't, if that tree trunk doesn't grow over time, then the tree will topple over. The third major financial statement, and the third major thing you need to look at, is the flow of water to your tree. If you run out of water, then your tree is going to die. And that is the same concept as the statement of cash flows, the flow of cash in and out of your business. Because if you get to a point with your business where your bank account is too low or empty, then your business is pretty much done. And that's very different than the income statement. And that's where a lot of people do get confused about what's the difference between an income statement and a statement of cash flows. And we're going to unpack that in this presentation, because they are very different, and it's important to know why. So that's my visual for understanding that as a business owner, you need to look at every aspect of your business, just like you're looking at every part of this tree to assess its health. So what I want to do is go through the statements and talk about them, and move forward and talk about how they relate to each other. So the income statement, as I said, most business owners are pretty familiar with. It's tracking your income. You take out your cost of goods sold, you take out your operating expenses, and then you have a profit or loss. The thing to understand about the income statement is it's measuring activity over a period of time. At the end of an accounting period, a fiscal year, the accounts on an income statement, so the chart of accounts that get reflected on an income statement get closed out, they get zeroed out, and then you start again the next year. The result of the activity moves over to the balance sheet. So we're going to look at that. This is an income statement that you would get out of QuickBooks. It is for a fake company that I created called Midcoast Orchard and Pies. Not meant to replicate any real business out there. If I am, it's completely coincidence. But this business is an orchard that has apples, and it also makes pies. So two different parts of the business. I'm gonna bring out my handy dandy laser pointer. Love this tool. So at the top, obviously income, everything you sold. Right here in this section is your cost of goods sold, and that's taking out those direct expenses. And then we have a gross profit. And again, the reason that we do that is we often will look at percentages. We'll take a percentage of our cost of goods sold as a percentage of our sales, and we'll create ratios to analyze how we're doing. We use that information to compare ourselves to prior years, and we can also compare ourselves to our industry. That can be a useful exercise just to give you a sense of how you stack up to others who are doing the same business. And we typically do that through the use of ratios. Afterwards, we have all those other kind of general operating expenses summarized, and then we get our net income, the 113,185. On the bottom is where you're going to see accounts for other income or expenses, and those are things that happen in your business but are not part of the of your business. For example, if I sold a piece of equipment in my orchard to somebody, that I'm not in the business of selling equipment, but I did get that income. So that's why it shows up on the bottom. And then our last one there, our final result is the 113,561. And just remember that number. So let's talk about how these statements connect to each other. And then we'll get into the details of a balance sheet. But if you run a balance sheet throughout the year, you're going to notice that the net income number is also showing up on your balance sheet. So here's your net income through December 24th, and it's showing up here. So really, the income statement is part of the balance sheet. It's just like a subsection of the balance sheet. It would just be too unwieldy to try to track all that information on a balance sheet. So the income statement was created. What this also is telling us that is that the balance sheet is actually the statement that's showing you everything about your business all in one place. It's just that the income statement is showing you the detail behind that number. And when the books are closed out, as I said, what happens is that net income gets rolled up into retained earnings, and we start again. So that's how the two statements are connected to each other. Before we go on to talk about a balance sheet, I want to introduce the idea of accrual versus cash accounting. It's not a difficult concept, but I think it causes confusion. And first we'll say that most small business owners follow cash accounting methodology, and that is perfectly fine, but I want to make sure you understand why you might want to at least report on accrual basis so that you're getting a real picture of your business. And also wanted to introduce this because some of these accounts I'm going to be talking about are on your balance sheet, they're balance sheet accounts. So we're going to take this example, which is a real example that happened to me. My septic system exploded during my busy season, and I had to get it repaired immediately, so I got a really huge plumbing bill. Under the cash method, I would have put that bill in a desk drawer, and when September came around a couple of weeks later, I go into QuickBooks, I write a check, and the date of the expense is the date that is put on that check. That's cash accounting. If I was following accrual accounting, I would get that bill in the mail, I would go into QuickBooks and enter it using something called the enter bills function. It's not paying a bill, it's just entering the information about the bill. And the second I save that, what's happening in QuickBooks is that it's getting booked as an expense right then and there to my business. And it's also getting tracked in an account called accounts payable, which is a balance sheet account. And it's an account that shows up it shows me what I owe to other people, other businesses. So why do we care? Well, if you think about it, if you ran a profit and loss for August, say I did that and it showed that I had made $10,000 more than I had the prior year, I think that was pretty cool. But what would not be reflected in that report is all of the bills sitting in my desk drawer, including my $5,000 septic system bill. So I really don't have an accurate picture of my business at all. And that's why accrual and entering bill information into QuickBooks when you get it, because that's the day that you're liable for it, it can be so important from an accounting perspective and from managing your business. And as businesses get bigger and bigger, they are required by law to file or to use the accrual methodology, because investors want to know what's sitting in your desk drawer. So I want to also show you oh, I forgot to show you that Luca here is reminding us that accrual just means the accumulation or increase of something over time. So accrual is just recognizing income and expenses when they actually happen, not when they get paid or when you receive them. So on the flip side is accounts receivable. This is an example that would probably never actually happen, because anybody who allows people to use house accounts or store accounts would be following accrual, but we're going to just use this example for demonstration. So my example here is if you own a small hardware store in your community and a contractor comes in and buys a bunch of supplies for a big job, you let him put it on his store account. If you were following a cash methodology, you'd send him a bill at the end of the month, and then he'd write you a check and send it back probably in September, and then you'd record the sale. With accrual, you record the sale the second he's at your cash register, and you're booking that as revenue that day. And then at the same time, or you send him an invoice, and at the same time, that money that he owes you is getting rolled up and tracked in an account called accounts receivable, and it's a balance sheet account. So I just want to talk about this because it's relevant to the balance sheet. Again, you may not have a business where you invoice people, or you know, everybody who buys something from you has to do it right then and there, but it's still a good method to follow. And in QuickBooks, you can file your taxes. You can tell QuickBooks that you're going to file your taxes using the cash method, but you can still run reports in the accrual method. So just wanted to point that out. So let's talk about the balance sheet. Basically, again, it's like the rings of a tree. It's showing you the growth from one period, and then you take a picture at another period and you see the difference. Another analogy I like to use is it's kind of like that photograph you get from your long lost friend in December or around the holidays, showing the picture of his family, and it's the only time you ever communicate with them. And each year you look at that photograph and you think, oh, the kids have gotten bigger, or they bought a new house, or Tina looks kind of tired. So it's all just kind of looking at the growth from year to year. And so it's a snapshot on a particular date. Oops, I'm so sorry. So what's on a balance sheet? So assets are on a balance sheet, and assets are always divided into current and fixed assets. Current assets are things that can be converted to cash within a year, and fixed assets are longer term. One asset that every business has is the money in their bank account. That is an asset of your business. Second is accounts receivable, and that is what we just talked about, tracking the money that other people owe you for sales you've already made. That's an asset. And then inventory, you might purchase inventory and sell that off over the year. Fixed assets, obviously things like furniture and equipment, vehicles, real estate, land. On the liability side, like we talked about earlier, liabilities are things that people owe, you owe people. It can be a line of credit, it's your credit card balances, accounts payable that you owe to other businesses. Sales tax you collect until you pay it out is a liability, and tips collected. It's also things like a long-term loan, a mortgage, those kinds of things. Equity, as we talked about, is the difference between assets and liabilities. That number gets impacted when you put money in or you take it out of your business because you're either growing or decreasing your share of that business. It's also gets impacted directly by what's happening from your business activity that's reflected on your income statement. So it's that retained earnings, that net profit that gets rolled up into equity. So I want to show you a balance sheet for my fake company. And again, love the laser pointer. So my business here has a lot of money sitting in a bank account. That might tell me that they need to think about investing that in their business in some way by increasing their assets. I've got about 11,000 in accounts receivable, and then I've got all this equipment down here, and the total of that equals 722,867. On the other side is liabilities and equity, and liabilities, I've got my credit card balance because I haven't paid that off yet. I don't have any accounts payable right now, and I've got a mortgage. So this also equals 722, oh, my screen just, there we go, 722,867. So we have talked about the balance sheet as assets minus liabilities are equal to equity, because that's a way that a lot of people can understand the concept. I sell off all my assets, I use the money to pay off all my liabilities, and I'm left with equity. But the real accounting equation is that assets are equal to liabilities and equity, because as you noticed on the balance sheet, one side was assets, the other was liabilities and equity, and they equaled each other. This is where people get a little bit confused. So if you are feeling like this, you're not alone. So we're just going to unpack something called the fundamental accounting equation. And this goes a little deeper into accounting. You don't need to know this, but you should have a basic understanding of it because it does impact what's happening in QuickBooks. So just like our other equation, where we said assets minus liabilities equals equity, we can turn that around in math and say that assets are equal to liabilities and equity, just like we can say 5 plus 3 equals 8, 8 minus 3 equals 5. So a way to understand this is that assets are paid for with liabilities or with equity. Another way to think about it is that liabilities and equity have claim on assets. But overall, it's a closed loop system. This equation always has to be in balance if your books are correct. If it's not in balance, then there's something wrong with your books. And what QuickBooks does is it's doing all of this balancing in the background. And it's probably doing it in ways you're not even aware of. It uses a whole system of debits and credits, you've probably heard of that, to make sure that this equation is always in balance. And for example, I'm just gonna give you an example of how this might work. If I purchased a truck and I took out a loan for the truck, say it was $25,000 truck, I would book that as an asset because it's an asset, it's something my business owns. But I also have to book the liability, my loan, and that's also $25,000. So that equation would stay in balance. It's just a way of saying that everything that goes through your books gets recorded in two places. And that's basically what double entry accounting is. And again, QuickBooks kind of does this for you in the background. For example, if you go and you write a check, QuickBooks asks you what bank, where is it coming out of, what bank account? a bank account is an asset, right? So when you write the check for that expense, your asset of your bank account decreases. And also on the other side, the expenses are getting recorded for the same exact amount, which will keep that in balance. Another way to think about this is going back to the filing system. I'm sure everybody's had the experience of going to your file cabinet with one piece of paper and thinking, oh, I could file this in 2 different places, and then hoping that you'll remember what method you used. So for example, say you had a bill that someone sent you. You could put it in a file folder at the beginning of your file cabinet for unpaid bills that you take out at the end of the month and pay, or maybe you could file it under the type of expense it is. What's happening in accounting is it's just recording it in both places because there's 2 sets of accounts that get impacted. And that's all that double entry accounting is really referring to. And again, you don't have to know the details of this. If you do journal entries in QuickBooks, you probably know that you always have to choose at least 2 accounts to keep this equation in balance. But hopefully you're not doing too many of those, because QuickBooks was really designed to make it easy for business owners by not really talking to you about things like debits and credits. So we're going to stop there because that's a lot of information to take in for a second and just take a little puppy break. Before we move on to talking about this statement of cash flows, which is another really important financial statement. So this is a question that a lot of people ask, which is, if my QuickBooks are telling me I made a good profit this year, why is my bank account so low? And it's the statement of cash flows that will explain that to you. So remember, there are no accounts in your chart of accounts that are cash flow accounts. It's just that this statement borrows them from the balance sheet and from your income statement. And it's actually the most recent financial statement that was developed in the world of accounting and financial management. I think it didn't come out till, mid 1900s. So it's kind of the Johnny come lately, but it's actually one of the most important statements. So what does it do? It's mapping the inflow and outflow of actual money in and out of your bank account. And when I say money, I mean cash, checks, credit card payments, e-checks, whatever value that's coming in and out of your bank account. So why is that different than your profit and loss statement? So it doesn't matter. The first 2 reasons I'm going to show you, it doesn't matter if you're following cash or accrual methodology of accounting. So the first and very big one is depreciation. So not all transactions involve actual cash. If you have assets and you work with an accountant, often the accountant, one of the things an accountant will do for your small business is come in at the end of the year and do an adjustment for depreciation. And what that means is if you have assets like a truck, car, well, not land, but building, then it loses value over time as it ages, just like a car does. More mileage, starts rusting out, it's not worth as much. The IRS allows you to take the loss of that value every year as an expense to your business, which then reduces your taxable income. But there's no depreciation commission that you write this check to, so money is not actually going anywhere, and it's staying in your bank account. So that's one reason. So it shows up on your income statement, and for some people this can be a big number, and it affects your profitability, but it's not a loss of cash. Another important example is if you have a loan and you pay a monthly loan payment to your bank. When you write that check, there's 2 parts of the loan, right? There's your interest expense, and there's the part you're paying back to the bank. So the interest you're allowed to take as an expense because it's the cost of doing business. It's an expense to your business. So that portion shows up. but the principal portion doesn't. That gets in QuickBooks, you would categorize that to the liability account that's for that particular loan, so that over time that liability account is paid down. But it does not show up on your income statement, but it could be a significant amount of money that's going out of your bank account. The same thing with equipment. If you purchase equipment, say with cash, it's not an expense to your business. You're going to book it as an asset to your business. So it doesn't show up on your income statement, but cash went out. This is something that you should also talk to a bookkeeper or an accountant about, because there's different rules for when you decide something's an asset and when you decide it's an expense. And it's usually based on a dollar number. I think in my business, I used, if I purchased something that was over $1,500, it usually got booked as an asset if it wasn't a direct expense, if it was for an asset kind of thing. So that's a conversation with your accountant. And then the third reason is for people who do follow accrual accounting. When you create an invoice and send it to a customer in QuickBooks, the second you save that invoice, two things are happening in the background. QuickBooks is booking that as income to your business right then and there. It's also booking it to accounts receivable to show you who owes you money, but it's not cash that you've actually received yet. So it's on your income statement, but it's not money that has gone into your bank. And then on the flip side of that is accounts payable. If you track your bills and put them into QuickBooks before you pay them, the expense is going to show up on your income statement, and it's also going to show up in accounts payable on your balance sheet, but money has not left your bank account. So this is a statement of cash flows for my fake business. And this is how it works. It's, once again, getting the pointer. So here's that number. Remember that number, that 113,561. That's what I made. And every statement of cash flow starts with the result of your income statement, and then it adjusts it to show you the flow of cash in and out of your business. So I have my 113. I have $15,000 that people owe me, but it hasn't gone into my bank account. So we're going to subtract that out because I haven't gotten that money. Same thing with my credit card and accounts payable. This is money that I owe, so the expense is on my income statement, but it hasn't left my bank account because it's in accounts payable. So that is going to be added back in. The statement of cash flows, by the way, breaks down into 3 areas: operating activities that affect your cash flow, investing activities, and financing activities. So under investing activities, here's that piece of equipment I purchased with cash. It was a big cash outlay out of my bank account, but it did not show up on my income statement because I booked it as an asset. It shows up on my balance sheet. And same thing with my payment here for my bank, my mortgage. That's not an expense of my business. I'm just paying the money back. I already got the income. I'm just paying it back. So it's not an expense, and it goes on my balance sheet to reduce my liability. But so cash went out of my bank account, but it did not show up on my income statement. So in this case, this is showing me that I had a profit of $113,000, but I started my year with $71,000 in my bank account, and I ended my year with $54,000 in my bank account. And that's all that a statement of cash flow is showing you. It's helping you keep track of the fact that money's moving in and out of your bank and you need to pay attention. And the income statement is not what's going to help you figure that out. So especially in a stressful time right now for small businesses, cash flow is really important. It's, people use the term cash is king, and that's for a reason. It's because if you run out of it, you're kind of in trouble. So before we go over to QuickBooks and take a look at the chart of accounts, I just want to summarize where we've been. So the chart of accounts is just a list of categories you use to categorize your financial transactions. There's 6 major types: assets, liabilities, and equity, and these are all balance sheet accounts. There's income, cost of goods sold, and expenses, and these are all income statement accounts. Every transaction affects at least 2 accounts to keep that fundamental accounting equation in balance. And then ultimately what this is all about is every account gets added up and then it gets presented on one of the financial statements, the balance sheet or the income statement, and then the cash flow statement just borrows from those 2 other statements. So let's go over to QuickBooks, and Kelsey, if for any reason you're not seeing my QuickBooks, please let me know.
Good for
So this is, okay. So this is my company, my fake company that I made up. I am using QuickBooks Desktop, but you know, there's also QuickBooks Online, which looks completely different. But to get to my chart of accounts, I'm going to go under Accountant and go to Chart of Accounts. I'm going to open that up. I'm going to give myself a little more real estate here. So there's a bunch of things I want to talk to you about using your chart of accounts. The first thing is how they're organized. Now that you know all about the different types of accounts, you're going to notice that everything is organized by account, starting with the balance sheet. So I have my asset accounts here at the top, and then I go into my liability accounts, like my credit card, accounts payable, long-term liabilities like a loan, and then I get into my equity accounts. After that, I see income statement accounts. So income, cost of goods sold, and expenses, all listed in that order. The other thing to notice is that there are running balances with balance sheet accounts. The balance sheet is always keeping track of the value of your business. So when you look at that, you're in QuickBooks right now, looking at on this particular day, that's the running totals on my balance sheet. That is not the case for income statement accounts. And that the reason for that is that the income statement, as we said, it closes out and it starts again. So QuickBooks, it does not, you know, they don't know what you're looking for because you need to put in a range of dates to get the information out that you want. You can even make that date range one day, but QuickBooks isn't gonna, you know, doesn't know what you want. So you're never going to see those there. So that might be something you've noticed in your chart of accounts, and that's the reason. Another thing I want to just talk about is some best practices for your accounts. One thing to really keep in mind when you're setting up your chart of accounts is to keep it simple. You should only track things if it has value, if that information has value to you for a management reason. So for example, if you are tracking office expenses, you know, a lot of us can get into the nitty-gritty detail and say, oh, I got to start tracking my paper and my pens and my pencils. And the more accounts you put in, the more likelihood there is for mistakes. And it's just sends you down a rabbit hole. So I would say don't do it. Only track things that give you important information for a management purpose. Because I see a lot of people do this and then they end up with this huge chart of accounts, and then their income statements are really long and hard to understand. Another major thing that I see people do that can be avoided is they try to use their chart of accounts to actually organize how they get information out of the business. So taking my orchard and pie example here, so I have an orchard and I also make pies. Some people might go into their expenses section and say, well, you know what, for my advertising, I want to create sub accounts, which you can create sub accounts that roll up into the main account. And I'm going to create one for the orchard and one for the bakery. And I'm going to do that for almost all these accounts. Don't do that because, again, you're just going to end up with a lot of information on your income statement, and there's much better tools within QuickBooks to do what you want to do without using your chart of accounts. So I'm going to give you an example. One of my most, well, let's actually first look at reports. Before you set up your chart of accounts, it's a great idea to go into the report section of QuickBooks and see what it offers you. Different versions of QuickBooks offer different levels of reports, but you're always going to get, some fundamental basic financial reports. One of those is a bunch of sales reports. So you can get a sales report by item. So I'm just going to run that by fiscal year. So what this is showing me is how much I made under each of the items that I sell. I set up this list so I can put it on invoices and sales receipts that I give out to people. And this is all the different kinds of things that I sell. That's the place I should be looking for that information. I shouldn't be looking for it by setting up, for example, on my income statement accounts, 10 different accounts for income. Because it's just going to be too much detail, and there's a better way to get it. Another great tool is something called classes in QuickBooks. So if I run a report, profit and loss by class, and I'm going to run for this fiscal year, what classes allow you to do, which is really cool, is it allows you to add columns to your income statement so that you can look at some of the different revenue streams you might have or the different parts of your business separately, but you're using classes, you're not creating sub-accounts. So, the bakery is one part of my business, the orchard's another. I want to see how efficiently I'm running each side. So I want to look at them separately, but I file my taxes under one business. So I'm gonna, this allows me to roll them all up together for tax reporting and for kind of an overall big picture, but using classes lets me have separate parts. So those are two really important tools to understand rather than using your chart of accounts to organize data. In QuickBooks Online, there's additional tools. There's something called, you can create reports by location. So if you have different locations for your business, you can use that to also create these columns. And you can also create it by, you could use those columns for sales channels. So if you say, in my orchard, I sell at a farm stand, but I also sell merchandise online. I could set up, locations by sales channel as well. And then finally in QuickBooks Online, there's something called tags. And tags are just like tags with photographs. You can tag each transaction with a name, and then you can run a report on that name. So lots of different ways to slice and dice what's happening in your business other than using the chart of accounts. So that is kind of my message there, because the more accounts you have, the more unwieldy it gets, and the more likelihood there is for mistakes. I also want to talk about my favorite account, which is the Ask My Accountant account. QuickBooks often sets this up for you. It's at the very bottom there. But you can add it, and you can add it as any type, usually an expense account. And this is a great account because if you were putting something into QuickBooks and you start second guessing or wondering if you're using the right type of account, then stop and put it in my Ask My Accountant account, because I have seen people put things into their books and choose an account because it quote unquote sounded right. And that's going to get you into a lot of trouble. If you are absolutely not sure what the account is, then put it into Ask My Accountant and then ask somebody, whether it's your accountant or a bookkeeper or somebody who knows. It's a great tool for just tracking that. So take advantage of the Ask My Accountant account. The other little piece of advice I'd like to give is if you're setting QuickBooks up for the first time, it's pretty simple to set up, for example, a bank account, which is an asset account. you would just, go here and you create a new account. You say it's a bank account, which is an asset account. You continue, and then you get to a point where you put all the information in about your bank, and you need to enter an opening balance. And it's pretty easy to do. You just take the ending balance of the statement before you're starting to track. So say December of one year, because you're going to start tracking in January of the next, and you put that in, and that number becomes your starting balance. So those are not difficult to do. But when it comes to other asset accounts, especially if it's an asset you've owned for a while, like a building or equipment, I would say that those are best left to your accountant if you really don't know how to do this, because the numbers that go into the starting balance are numbers that come from your tax return. And those are, talk to your accountant before you put those in, because you do want to get an accurate picture of your business. And so that's where an accountant can come in handy. Another tool that I want to just point out is using account numbers. You can turn this feature on and off. I've turned this off. I've turned it on, but you can do that in the desktop by going to your preferences. The reason I think people get a little nervous about using account numbers, because they think there's some really important reason that there's a certain account number on an account, and it's really just for organizational purposes. If you turn on that feature, what QuickBooks will do, there is a standard way of using account numbers, and it's that asset numbers always start with 1, and then liabilities start with 2, equities start with 3, and then you get into income, cost of goods sold, and expenses. So the first number matters. After that, it doesn't matter at all. And the reason that you would use these is if you don't use them, QuickBooks is going to organize your financial statements, like your income statement, alphabetically by type. So if you have your expenses, it's going to go alphabetically. And sometimes you want to see it differently. You might want to see the accounts where you spend the most money at the very top. So all you would do is create a new account and give it a number, so it's going to end up at the top of your expense list. And that's why you use account numbers. So don't be scared to use them if you want to reorganize the way that your income statement might be showing expenses, for example. Let's see. I think that is it for my presentation. So just keep it simple. Become familiar with all of the other ways to view your data in QuickBooks, so that you're not using your chart of accounts to organize data. Talk to your accountant if you don't know, because you want QuickBooks to work for you and give you, a really accurate picture of your business. And use that ask my accountant account if you don't know. So Kelsey, you want to let me know if there's any questions?
Well, that was great. Everyone is loving your graphics, in particular the crazy-eyed dog. I think a lot of people identified as that dog and felt sympathy in the acknowledgement of it all. So a couple questions. We've got one from Chris. Will QuickBooks automatically assign the accounts number if you put in the type? Does that question make sense?
You can turn numbers off and I'm not exactly sure I understand the question, but if you turn the account numbers off and on, QuickBooks will put them in the order like we talked about, assets starting with 1. And then after that, when you add an account, so if I go to a new account and say I just choose an expense account, at the top, I can put in the number, and you can just choose the number based on where you want it to show up in that list. Does that answer it?
Yeah, I think that makes sense. I just want to make sure, because there are sometimes people, if they start assigning numbers, can be like, they've already assigned a number. So I just didn't know if there was a fail-safe. Like when you put expense in there, Tina, if, and it does it automatically give the first the correct first number of what expense should be.
Oh, no, you're going to have to
So
look at that.
you have to pay attention to what
Yes.
you're doing when you're putting in these numbers. I just want clarity on that.
Yes, yeah.
Yeah, okay, thank you.
We did have a question about a link for the replay. And so, yes, I will be sending a follow-up email shortly. It usually takes a little while for the video to process all the way through. Sometime this afternoon, you will get a link to the recording as well as the slides. So if you feel in over your head, you are fine. You got time to come back. We have a question that's, what is the draw? I don't know if that is isn't true. I know draw is an accounting word, vocabulary word.
Yeah. So if you are a business owner and you file your taxes as like a Schedule C filer, like many people do, you basically figure out how much money you took in, how much money you took out, you put that on a Schedule C for your tax form. That's how you report your taxable income to the government. Throughout the year, you may elect to pull money out of your business. Like your personal bank account is running low, you've made a bunch of profit, you're going to pull it directly out of your business bank account, and that's perfectly fine because it's how you pay yourself. When that happens, you want to categorize that as a draw, which is an equity account. You're reducing your equity in the business. It's not an expense of your business, so that's what it's used for. If you happen to be an S corporation, then you would have yourself on payroll like an employee. You can still take a draw, but that's, typically people who are not S corporations and aren't on payroll, they just take money out of their business to pay themselves. And that's what you use the draw for.
There we go. Another thank you. This was so helpful from Shannon. And then how do you close out EOY? End of year? End of year, I would guess.
End of year.
Maybe.
Yeah, okay. So there's a setting in, so QuickBooks is always keeping that accounting equation in balance for you. Your accountant will also go through a process of running what's called a trial balance to make sure everything's adding up correctly and there's not any weird things happening there. So if you do use an accountant, they often are going to do those what are called closing entries, trial balance, to make sure everything's adding up correctly. Your debits equal your credits. You can also in QuickBooks turn on something in your settings that is that says close the year, and you can put in a date. So say your fiscal year ends on December 31st. You can put that number in, and what that does when you turn on that setting is if you try to go back and change something from the past, from a year that has closed, QuickBooks will give you a warning, or you can even set it up so you have to put in a password, because you don't want to go back and change anything from the past if you've already filed your taxes. But yeah, there's a closing process that's happening behind the scenes, or your accountant is going in and looking at accounting reports. And there are financial reports you can run that are accounting related to look at that. And, if you want to know more about that, there are some great resources for learning more about how accounting works. I did want to mention one, and for some reason, Kelsey, I don't have my chat. So I'm going to just say it.
If you unshare your screen.
Oh, will that do it?
It'll pop right back. It'll be down there. Yeah.
Okay, there we go. All right, I'm going to put in a resource that I came across recently that I really think is fabulous. It's a book. It's called The Accounting Game. Some of you might have heard about it. It takes the example of a lemonade stand and helps you understand all of the concepts that I just went over. It's by Daryl Mullis and Judith Orloff. It's great. You know, it's a lemonade stand. We can all understand how a lemonade stand works. So, but it gets into the basics of these concepts. And so if any of these were still totally Greek to you, which is perfectly understandable, this is a good tool for doing more research.
Great. Another question from Christina. Where do you categorize contract labor? There seems to be two places. And then later she says cost of labor, COS versus contractors' expenses like payroll.
So if you were keeping track of someone who is not an employee, so a subcontractor, somebody you give a, you know, their own separate tax form at the end of the year, that would be an expense of your business. So you would just create an expense called contracted labor. If it's payroll, that has its own categories because you're collecting payroll tax as an employer. So typically you'll have wages and salaries as an expense line, and then you'll also have payroll expenses, which includes the taxes you collect and also maybe some expenses if you're using a payroll company. Payroll, that can get a little complicated if you're not using a payroll company, because that is confusing for all of us. QuickBooks offers payroll services that you can purchase at different levels. There's also plenty of payroll companies in Maine. You can often get that service from your bank. So might be something to consider.
That makes sense. Can you explain why you have to separate out your credit card?
Okay, so this is something that is important to set up correctly, and it's definitely one of those things that people do incorrectly in QuickBooks. So when you set up your accounts, your chart of accounts, you go and you create a new account and you say it's a credit card account. And then it will ask you for your when you want to start tracking it. So if it's a new year, you're going to put your balance from your previous statement in December as your starting balance. And then what happens, and this gets into how to use QuickBooks correctly. You want to enter every purchase you have, either coming through your bank feed or entering it manually as a credit card expense. And you're gonna categorize the type of expense. So if I went out and I bought office paper, I'm gonna put it under office supplies, and I'm gonna say I took this expense using my credit card. This is important because what's happening in the background is you get to categorize each individual expense from your credit card, which is important. We all use credit cards a lot. And then it's also accumulating in a liability account on your balance sheet to show you how much you owe. What I have seen people do is they get their statement, their credit card statement, they go into QuickBooks, they assign a percentage of the statement to each type of expense and then just pay it like an expense. And that is just not a correct way to be doing this. And QuickBooks makes it easy. There's a way to pay down your credit card. There's a function to do that. So you want to make sure you are setting that up correctly. And if you don't understand what I just said, please reach out to an advisor. We can help you look at what you're doing and give you a big picture of what's happening in your books. I've looked at people's books where all of the numbers on the balance sheet were negative, so that told me something was very wrong. So we're happy to do that for you. There's also lots of tools out there in terms of like YouTube videos, free training that you can find, or it's worth it to talk to an accountant or a bookkeeper when you first set up QuickBooks, because what they can do is make sure you've set it up correctly, teach you how to use it, and you can do the rest. You don't have to pay them for the rest of the year to do this for you, but it is absolutely worth it to have someone set it up correctly in the first place. Sorry, that was a long answer.
That's all right. Sometimes these questions are complicated. A couple more thank yous and compliments. So again, well done. Jim is asking, where do you put grants for others or PPP? he says, I got my grant in late December, so it will be used in 2021.
That's a great question that lots of people are dealing with, and I'm going to punt that to your accountant and bookkeeper, because there's several different ways that you can do that, and I don't want to give advice because I'm not an accountant, and to make that absolutely clear. So please talk to your accountant, and if you don't have one, there are ways to do it that perhaps we could help you with if you want to talk to an advisor, but I really think you should be talking to your accountant about that, because it's going to have tax implications for your business as to whether it gets classified as income that is taxable or not. And some of those questions are actually still up in the air. The PPP is not taxable income, but the state of Maine grants might be. So clear as mud, but yeah, talk to your accountant when you're ready to do your taxes.
I second all of that. It looks like the last real question here is, how do you manage the expense of commissions or processing fees which get debited from sales or exempt sales, since sometimes places like Etsy pay them for you?
Again, I think it's a really specific question to your business, and if you want to give send me an email or just request advising through our website, then we can take a look at that. We can do a Zoom call where you can share out your screen and we can actually look at your books. Yeah.
So again, we are highly recommending that you reach out for one-on-one business advising. Like Tina said, there is no like small question. There are no stupid questions. We're here regardless. Tina's contact information will be in my follow-up email. So if it pertains to today or is a follow-up to something she said, definitely reach out. Otherwise, go ahead and hit that advising button and we will get you in touch with the closest business advisor to you. Again, lots of thank yous and good jobs. So
Kelsey, I think I direct messaged the accounting game information to someone on the call rather than sharing it with the group. So
I will include that in the follow-up email. Listen, we've all been there. The direct message versus the whole group is it's a learning curve. So yeah, I will include that book information in my follow-up email as well.
Okay.
Awesome. Have a great day, everyone.